The Bank of Canada has chosen to leave its key interest rate unchanged at 2.25%, with the bank rate staying at 2.5% and the deposit rate at 2.2%. This decision comes during a particularly challenging period for Canada's economy, where opposing pressures are shaping the outlook. On one hand, rising tensions in the Middle East have driven up oil and gasoline prices, adding fresh upward pressure on inflation and increasing costs for households. On the other hand, tariffs from the United States are weighing on Canada's export sector, discouraging business investment and affecting employment in certain industries. Given these conflicting forces, the central bank opted against lowering rates, as cheaper borrowing could intensify inflation, especially with energy prices already elevated. At the same time, raising rates was also ruled out, since the economy is still fragile after shrinking in the final quarter of 2025 and only showing modest improvement in early 2026. For homeowners with variable rate mortgages, this pause means their monthly payments are not expected to change right away. Similarly, individuals with loans or lines of credit tied to prime rates will likely see borrowing costs remain stable for now. However, fixed mortgage rates have been trending upward since January, largely due to rising bond yields influenced by inflation concerns and global uncertainty. Inflation continues to be a central issue. Canada's Consumer Price Index climbed to 2.4% in March 2026, mainly driven by higher gasoline costs. The central bank anticipates inflation could rise to around 3% in April before gradually easing back toward its 2% target by early 2027, assuming oil prices stabilize. Meanwhile, the labor market remains under pressure. Unemployment is hovering between 6.5% and 7%, with job losses reported in sectors impacted by U.S. tariffs. Hiring activity has been relatively weak, adding strain on workers, newcomers, and families already dealing with higher living expenses. Looking ahead, the bank forecasts economic growth of 1.2% in 2026, followed by 1.6% in 2027 and 1.7% in 2028. While a gradual recovery is expected, much will depend on global factors such as energy prices, geopolitical developments, and trade policies. Beyond mortgages, the effects are being felt in everyday life. Rising costs for fuel and food are tightening household budgets. To help ease the burden, government measures like the groceries and essentials benefit, along with reductions in federal income tax rates, are aimed at providing some relief. At this stage, the central bank is closely watching whether higher energy prices begin to influence other areas of inflation. It is also assessing how U.S. trade measures are affecting exports, business activity, employment, and overall economic momentum. The next rate decision is expected in June. For now, Canadians should not anticipate immediate relief in borrowing costs, as policymakers remain focused on carefully managing inflation risks while supporting a still recovering economy. Channel, Canada Reality Hub.